Probate valuation. The basic point to hold on to here is that valuation is at the time of death of the estate owner. That makes all the difference between probate valuation and all other types of valuation, apart from the fact that it is statutory and on the other parts non-statutory valuation. The valuation is at the time of death. That is the key to solving problems here on probate valuation. But let's discuss it. The purpose of probate valuation. When an owner of a real property dies or personal property, the estate duty becomes payable to the estate on the capital value of all the properties passing on death, including gifts made within a few years to death, which is deemed to pass for the purpose of estate duty. Now, estate duty becomes payable to the estate based on capital value of all the properties passing on death. The tax is it's a form of tax anyway. It's called estate duty, which is an estate tax. The tax is used to finance welfare services in the state, in particular, and the country as a whole. And it is put in place to discourage the acquisition of inheritance by survivors or of the deceased person, because you find that in some areas in this country, in Nigeria, you find some children waiting for their fathers to die so that they can take all the estate that he has left behind, and they do not have the slightest intention of paying tax to anybody. So they just wait on that. They refuse to even work hard. In some areas, yes, it has been reported. So this is also to discourage that, So the basis of valuation for probate is the principal value. That is the value, or if you like, the price. The value is more appropriate here, which the property will fetch if sold in the market at the date of death. Those are the operative words. As at the date of death, no allowance being made for possible expenses of sale. Now, let me go back a little bit. When a person dies in an estate without leaving a will, it will require letters of administration, which will be obtained from the office of the chief judge or the high court judge, so that his estate can be administered after he has died. But if he dies without leaving a will, intestate, he will need administrators, yes. If he dies leaving a will, then what we will need is probate. A probate letter is often obtained from the high court, the office of the chief judge, and and the estate will need to appoint executors. Administrators, if he died without a will; executors, if he died leaving a will behind. So please, this fact must be known. It's an estate duty tax, which is payable on the death of an estate owner based on the principal value of his property as at the time of death. Probate valuation is regulated by the CCT Law of 1979, which later became Cap 42, Laws of the Federal Republic of Nigeria 1990. As I said before, it is a statutory valuation because it is prescribed by the law. Probate valuation principles do not differ from other types of valuation for sale or other purposes, but the basis is the principal value. That is the value that the property will fetch if sold in the market as at the date of death. No allowance being made for possible expenses of sale. That is clear. So the valuation report is required at the death of the owner or sometimes thereafter, because it is to be attached to a probate form usually given by the probate registry of the state high court. The valuation report is required for that purpose because it will be attached to a probate form given by the probate registry of the state high court. In reality, it was the Tinubu administration that adopted, sort of sidetracked this valuation and adopted some subjective spot value system for each district of the state, upon which the tax is levied at 10% flat rate. Before that administration, it was based on pure valuer's report, which will be attached to the probate form and submitted to the probate registry. But it's now different because they have their spot values that they use, but it is incumbent on the practitioner to know the professional way of doing things and how it should be. How it should be. So you must have an idea about that. Then there are some notes and assumptions which you must bear in mind, that the property is placed on the market in a manner likely to produce the best possible price at that time, because you have to look back now to the time of death. The investment method of valuation must be used for the determination of rent passing on comparable properties in the locality, with allowances made for annual outgoings from the market rental or rack rental value. The resultant net income is then capitalized. So this is just a straightforward valuation, investment valuation, but as at the time of death. And no deduction should be made for any expenses of realization in the case in which you have to deduct valuer's fees and deduct other fees, so that you come to a net value upon which the tax will be based. This is not usually the practice. The valuation for probate should take account of statutory provision, such as the town planning regulations, rent edits, and so on, because it's statutory. So all laws that are related must also be taken into cognizance. So for this valuation, two principal methods of valuation are in use in order to arrive at the principal value of the estate. One, the investment method. Two, the comparative method. And the comparative method means both the direct and indirect value comparison. They are both applicable here. The investment method means any income approach method, because investment relies on income. So profits of accounts and all that, they all fall under it. So two main methods. I don't think that there is no other method, or there are no other methods that are to be used for this purpose. You either use the investment method or you use the comparative method, or both of them where applicable. A hybrid of A and B will be advisable, because in most cases, before you apply the investment method or during your application of the investment method, you also use comparative method, indirect value comparison. So they are complementary to each other. So what are the problems and the inadequacies of the probate valuation? Rental evidence as at the date of death may be difficult to get, because you have to go back in time. Clients will want you to undervalue their properties because for tax purpose. So they do all kinds of things to get the value as low as possible. They can pay a low tax. Then it's statutory, so you must do it according to the law. No input of your experience or principles of valuation, additional principles are required. Then the state, you must bear cognizance of the state of the property as at the date of death. So whatever state the property was as at the date of death is what you take cognizance of. Even if it has been rebuilt today, it doesn't matter. You have to go back in time and see and ascertain what it was then and place a value at that. So you look backwards. Perhaps one of the valuations in which you look backward rather than forward. So the state of the property is also difficult to ascertain. If you are valuing 10 years after, how would you be assured that whatever you are told that the state was actually what it was. But that's what your basis should be anyway. So let's look at a worked example. But before we do that, the calculation of tax amount really is as provided for by the CCT Act of 1979, or what is now referred to as Cap 42. What's the name of the cap again? Cap 42, Laws of the Federal Republic of Nigeria, 1990. So the rates are specified there, and that includes the values of the movable items, which are usually added to the value of the principal value of the property before the rate is applied. So the rate is not applied only on the principal value of the property. You have to add other things, and you deduct burial expenses and so on and so forth. This is contained in the provision of the tax, CTT Act of 1979, Cap 42, Laws of the Federal Republic of Nigeria, 1990. So if I advise students to look back at that law, I'm sure you have done it before. Look at, so if you want to calculate the total amount of tax, you will have added for the movable properties as well. But if for the purpose of this exercise you just want to know what tax is payable based on the rate allowed for, without including the movables, you can also do that. That's why it's necessary for you to go back to that law again, because that makes a lot of sense. Now look at the worked example 7. You will see that the question, what you have to look out for is the time of death, the date of death. That is the most important thing. And rent passing as at the date of death. On the field, you may not know this rent passing. You have to go back in time, check records of sales and lettings at the time of death, and be able to come out with a reasonable rent, a rack rent, which you are going to capitalize. So the information here is that the deceased owner died on the 3rd of April 2002. That's like 18 years ago. So you have to go back 18 years and look for what the market rates were at that time. Then the rent passing to, you have to go back, but fortunately you are giving here as 3,000 per flat per annum. Then you go through the normal valuation, 2 flats that are 3,000 per annum, that gives you 6,000. You less outgoings, the fees payable, for letting and management of the property, management fees, insurance you deduct, maintenance and repairs and maintenance, then you come out with an annual renter, net rent, then you capitalize. If it's a freehold property, then you use your YP impaired at the appropriate market rate at that time that time of death. Then you come up with a value of 44,998. That will be your probate value. I've done quite a number of them, and this is the way I also did them. Probate value, say 448, as at 3rd of April 2002, when the man died.